Greetings, my name is Ted Hicks. I'm the founder, CEO, and Chief Investment Officer for Hicks & Associates Wealth Management. Today is Friday, July 15th, and I want to provide a brief update on inflation. In last week's video, we asked the question, has inflation peaked? And we showed you a few charts that suggests that the stock and bond markets are indicating that inflation data may have indeed peaked. However, just this week, the Department of Commerce released its official update on inflation. So let's look at that chart now. So on the screen right now is the inflation data, the rate of change year over year. In the top right corner, you can see my data is actually showing 9.0. The official data is 9.1. So there is a discrepancy on my chart. I will get that fixed in the coming days, but it's close enough for our conversation today. Again, the point that we made in last week's video was that there is data in the stock and bond markets that suggests that inflation might have peaked. Well, then again, this week we get an official print from the U.S. Department of Commerce, and it says inflation is 9.1. Here's the point. Last week's video is not wrong. The point is the Department of Commerce official data, it's a lag. It's looking in the rear view mirror. The stock and the bond markets are looking into the future. So when the stock and the bond markets, when those commodity figures are starting to come down, that's forecasting that inflation is coming down. The Department of Commerce's data is looking behind us. What has already happened? The stock market is saying this is what the participants in the stock market and the bond market and the commodities, this is what we believe is coming. This is what's about to happen. The next quick point that I want to make is in relation to our real GDP, or gross domestic product. Again, that's the way that we measured the economy. You'll recall that the first quarter came in, I believe it was negative 1.5. Again, it's a rounding error or something in my system. I'm showing negative 1.6. Again, I clearly got to get that fixed. But then let's look at the Atlanta Fed. The Federal Reserve Bank of Atlanta, they have this tool called the GDP Now. You can look it up, just Google Federal Reserve Bank of Atlanta, you'll find it. And what they've got, this GDP Now, is they're saying GDP now, the latest estimate for the second quarter of this year is negative 1.2. The good news is that is better than it was. It has come up, but it's still a negative number. Now, if we go back and we look at our official charts and whatnot, 2 consecutive quarters of negative GDP, that's where the Department of the National Bureau of Economic Research is going to declare, yes, there's a recession there. That is a classical definition of a recession, is 2 consecutive quarters of negative GDP. So again, Atlanta GDP Now is not the official forecast. It is just a good estimate. We should get the official first estimate of second quarter GDP on, I believe, Friday, July 28th is when that data will come out. So stay tuned for that. So while we expect the National Bureau of Economic Research to officially declare the United States in a recession in the coming days, weeks, months, whatever, many of us would contend, certainly we have been, that we've already been in a recession. We're not waiting for the NBER to declare us as a recession. We are looking at the data, the wisdom of the counselors, if you will, the counselors being the market participants, and seeing what the stock and the bond markets and the commodity markets see. What are those participants suggesting? Again, those markets are future, they're looking into the future versus the official data from the government is looking in the rear view mirror. So while we expect that official declaration of a recession to come, we also want to take a look at what is the Federal Reserve doing to help fight both the recession as well as the high inflationary environment. And historically, when we enter into a recession, the Federal Reserve is going to lower interest rates. Well, this time what they've been doing and what they're going to continue to do is they're going to raise interest rates. That again is opposite of what they typically do, and they're doing it this time because they have to fight inflation. Effectively, what they're saying is slaying the inflationary dragon is more important than avoiding a recession. So while we would say that we've already been in a recession, their suggestion is that we're going to be in a longer recession because the Federal Reserve is effectively saying we have to fight this inflation by raising interest rates, and that is historically going to slow the economy down. So on the screen right now, you see that the effective federal funds rate has already risen to about 1.58 or 1.6, and the Federal Reserve is suggesting that they're likely to get to 3, maybe even 3.25 by the end of this calendar year. You can see that I've drawn that green line. You have to go back to 2008 to see rates that high. We haven't been in a rate environment that high since 2008. So that is something for us to keep in mind. We are in a rising interest rate environment that does dictate some things that we do in an investment portfolio. If you're a client of ours, don't worry, we've already been making those types of changes. One last point before wrapping up today's video, and that is news out of India. On the screen right now, you see an article from Reuters, and the article talks about how the Central Bank of India has made arrangements so that imports and exports into and out of India can now be settled in the Indian Rupee instead of the US dollar. For those that don't know, most international trade is settled in the US dollar. The United States dollar is the current world reserve currency. We've had that status for quite some time now. And if we lose that status, if the United States dollar is no longer the world reserve currency, that is a massive headwind that our nation will have to face. We have kind of wind at our back when we are the world's reserve currency. There is a fair amount of research to suggest that when a nation or an empire, if you will, loses world reserve currency status, it is not good news for that nation. Again, that's not the purpose of today's video, but I did want to let you know that is yet another sign in the global economy that the United States dollar is beginning to lose its credibility or continuing to lose its credibility. And there are many small dominoes that have fallen over the years. This is the latest, that the United States dollar may very well lose its world reserve currency status, and that will not be good news for the United States economy. That said, I'll wrap it up for today. Hope you found this video helpful. If you do like these videos, we do ask that you hit the like button. Please subscribe while you're on the channel, and by all means, feel free to share these videos with others. Hope you have a great weekend, and stay tuned. We'll be back in touch soon.